Okay, well, thanks very much, Tom. What I want to do, and I'm just going to spend 15 minutes or 20 minutes doing it, I want to try and say a little bit about the overall economic background, which necessarily forms the backstop to the investment background over the next 5 or 10 years. And the critical element in it from our point of view is the Eurozone crisis, which has been going on now for 4 or 5 years. And there's a lot of misconceptions about it. There's a lot of countries pushing their own agenda. There's a lot of disunity at European level in dealing with it. A lot of acrimony between the member organisations of the famous Troika. You may have noted, some of you, the IMF and the EU Commission having a big spat in public over the last couple of weeks. So I want to tell you what I think the Eurozone crisis is about, how it arose, and where it is right now, and what way I think it's going to play out. And I start with a quote from a guy called Jörg Asmussen, who's a German guy who's a member of the Executive Council. In other words, he's a full-time, senior full-time executive in the European Central Bank. And he said in 2011, there's no euro crisis, it's just a government debt crisis. Well, I don't agree with that. Let me just say a few things about European sovereign debt. Until the Greek default, there hadn't been a default in Western Europe since 1953. That was the London Agreement, which, amongst other things, forgave the Second World War debts. The actual Greek default was the biggest sovereign debt default that there has ever been anywhere, and that occurred in the Eurozone. And one of the reasons why Eurozone sovereign debt has become so dangerous is because countries can no longer run slightly higher inflation rates and a softer currency. And some of you will remember back in the 1980s and 1990s, the Italian lira used to depreciate a little bit every now and again, but Italian interest rates were higher, and the inflation rate in Italy was a little bit higher, and the German mark was stronger, but inflation rates in Germany were much lower, and the overall real returns to investors as between the different currencies were compensated, so to speak. But you can think of it as saying that that meant that Italy could have a kind of a small, soft default every now and again of 5% or something like that. Of course, once countries abolish their currencies, they can no longer do that. And they're placed in the position of essentially not having an exchange rate, and not having a currency, not having the option of central bank financing of the government, and not having this option of soft default through realignments of the exchange rate. And I think what we've seen now is that if you eliminate the option of these soft, occasional soft defaults or realignments, eventually you run the risk that you get a big one. And the pressure cooker has to let the hot air out somewhere. Okay, this is a chart, it's not quite up to date, of bond yields from 1993 until the end of last year. And you can see that until the euro was introduced, that's the first vertical line is when the euro was introduced, the bond yields were different, but they converged very dramatically. And many of you will remember the great convergence play in European bond markets through the 1990s. And then until the second vertical line, which is the collapse of Lehman's, which was in September 2008, the yields, these are 10-year bonds, the yields on 10-year bonds in the various European countries were nearly the same. The markets had assumed, if you like, that there was no default risk or very little default risk attaching to these various bonds. And then, of course, after the financial bubble burst, people began to realise that there was default risk, and they were right in the case of Greece, where there was a very substantial default. But to go back to what Jörg Asmussen said, and you hear German spokespersons and Dutch guys and people from Northern Europe generally tossing out this line all the time that the problem is that the Southern European governments were borrowing too much money, they were on big budget deficits, they were irresponsible, they were lying around on the beach drinking ouzo or whatever, and that's really how the problem arose. And this is a pretty convenient narrative if you're speaking from Frankfurt. However, it's not true. Until 2007, only in Greece and Portugal was there a persistent pattern of high budget deficits. In Spain and Ireland, two of the countries that have been hit hardest, the problem was a credit-fueled property bubble. In other words, the problem was in the banking system, not in the government budget. In Belgium, Greece and Italy, there were high debt ratios above the limit that everybody was meant to observe, but all of the other Eurozone countries were inside that limit. And Spain and Ireland actually had amongst the lowest debt ratios. And they're the figures for balance of payments deficits. I'll come to the components in a moment. And you can see that Germany and the Netherlands had very big balance of payments surpluses, and Greece had a big balance of payments deficit. Portugal had a big balance of payments deficit. Spain had a significant balance of payments deficit, and Ireland had not a huge debt, but a pretty significant deficit as well. Now that should say, hold on a minute, that's interesting, because they're four of the countries that got into the most trouble, and of course the counterpart of a big balance of payments deficit is capital inflows into your banking system. If you have a big balance of payments deficit, it gets externally funded. So those countries were accumulating substantial external financial liabilities over that period. And Germany and the Netherlands were accumulating external financial assets, not really to do with the government budget deficit. So if you'd been alert to the patterns in that chart coming up to the crisis, you would have said that the countries that got into trouble were the ones that were liable to get into trouble. This chart shows the financial balance of the private sector. And the following is true. It sounds odd when you hear it first, but it is true. If you add up the financial surplus or deficit of the private sector, the financial surplus or deficit of the public sector, and the balance of payments deficit, the sum of those three things is equal to zero. Why is that? Well, we don't do business with Mars. So if you add up the private sector, the public sector, and foreigners, that's the whole world. And the whole world's financial surplus or deficit with itself is zero. So if the private sector has a big, say, negative financial balance, the public sector has a similarly big surplus, then the balance of payments deficit will be zero. The three of them have to add to zero. Now, in the countries that got into trouble, they had very big private sector imbalances, and you can see them there. Spain, these are expressed as a percentage of GDP. Spain is down there, Portugal, Greece, and Ireland. Now, it so happens that in some of those countries, the public sector had a small surplus, but not big enough to keep them out of external deficit. And that's what happened. The three countries that were first into EU IMF rescue programs had very large private sector deficits. In other words, the private sector was borrowing heavily abroad, loosely. And so did Spain. And those deficits were partly offset by the public sector. But these are the public sector balances. And note that the public sector balances prior to the crisis were positive in a lot of these countries. Look at Ireland, for example, which is the second, the heavier of the two green lines. There was actually about a government budget surplus in the years prior to the crisis, but it was more than offset by the private sector financial deficit. And you can see that Greece, of course, had a huge budget deficit all the way through, which they lied about as well, but that's another day's work. So eventually when the balloon went up, there was a big liquidity crunch which reversed the private capital flows, and foreigners sought to withdraw credit from the economy, and that reversed these private sector deficits. They were substituted by rising public sector deficits, manifested inevitably in big budget deficits in breach of the EU Stability and Growth Pact. So there are now 4 countries of the 17 in the Eurozone that are in official lending programs, and they're Greece, Portugal, Ireland, and most recently Cyprus. And there may be more. Slovenia is the favourite to be next. Interestingly, for the Eurozone as a whole, the balance of payments deficit in the period since the euro was founded has been approximately 0. And that is the pattern of external balance in the Eurozone as a whole. There's 16 countries included because one of them, Estonia, just joined towards the end of that period. And what does that say? Well, that says that Europe as a whole doesn't have balance payments deficit, which raises a very interesting question. What's the IMF doing here? The IMF is a kind of credit union for governments, is the best way to describe it, which sits in Washington, and when a state runs out of liquidity, there's just huge capital outflows, they can't sustain the exchange rate or anything else, commercial banks won't lend to them, then the IMF steps in. So the IMF is invariably involved in countries that have big balance payments deficit. But it got involved in Europe. Europe doesn't have balance payments deficit, not according to this. And I think that explains a lot of the tensions that we've seen between the fund and the Europeans. So what happened? What happened was that these 17 countries, 16 and eventually 17 countries, had a common currency, a sort of a central bank, but they didn't have the architecture of a monetary union. And what happened was that the zone as a whole ran very small external surpluses or deficits. It ran a low inflation rate. The currency was stable, more or less, against the dollar and all the others. But there were regional credit bubbles underway in various parts of the Eurozone, intermediated through poorly supervised banks. And those regional credit bubbles obviously occurred in Ireland in spades, also in Spain, but to a degree in Greece and Portugal, and even to a degree in other countries that were in the Eurozone. There have been banking problems throughout the zone, not quite as serious as here. And there were also banking bubbles in Britain, in Denmark, and in various countries, Iceland most spectacularly, that were not in the Eurozone at all. So the problem is that in the common currency area, these regional credit bubbles created problems for those regions, like Ireland and Spain, having deprived their governments of the instruments that they would traditionally have used to deal with. And that's the essence of not having a currency. So sovereigns in the Eurozone face high default risk. They can't create euros. Ultimately, a government bond in Guatemala is a promise to pay Guatemalan currency, and at 5% a year, and then eventually they'll pay you back 100 Guatemalan pesos or whatever they use for money over there. And they can meet that. There's no default risk. They can print it off. In a common currency area, you can't. So the European countries that joined the euro really put themselves in the position of Latin American countries that can only borrow in dollars. In other words, their borrowing is in what, for practical purposes, is a foreign currency. In addition, the ECB has been prohibiting, until Cyprus, haircuts for unsecured senior bank debt. And that created a contingent liability, which of course puts people off buying sovereign bonds. Cyprus, I think, changes that. So people who hold bonds issued by a Eurozone government, up to now, have had to contend with the following. These guys are going to put the bank bondholders ahead of me if there's trouble. So, you know, when a country gets into trouble and you hold a sovereign bond, you might want to cash it in. You get nervous and you go along to the counter to cash it in, and you find a whole lot of other fellows have been allowed into the queue ahead of you that don't own any government sovereign bonds. And they're called bank creditors. And that problem was exacerbated then when these countries went into official lending programs, because the official lenders said, we're also senior to anybody who might hold sovereign bonds. And that's what happened, as you know, in Greece, where the official lenders to Greece insisted on seniority. The IMF always does, but the ECB and the EU did, and the private sector holders of Greek sovereign debt got a commensurately bigger haircut because of that. So is it a sovereign debt crisis? Well, they turned it into a sovereign debt crisis, but with the sole exception of Greece, this has been a private credit and banking bubble whose consequences escalating public debt and budget deficits. So I think to say that the source of it was fiscal irresponsibility is true in Greece, but it's not really true anywhere else. It's been exacerbated by the absence of bank resolution, and it's been exacerbated by official lender seniority, as I've just outlined. This is a quote from Patrick Honohan, who's now the governor of the Irish Central Bank, and he used to work for the World Bank in Washington. He did a lot of work for the IMF as well over the years. And in 1999 he wrote a paper about contingency planning for banking crises. And I should explain that banking crises are very common around the world. The idea that banks go bust, it seems to me to have come as a bigger shock to people in Europe than it should have done. There's a banking crisis somewhere in the world nearly every year, and there's a big database of them on the IMF website of every banking crisis there has been around the world since the 1950s, and there have been hundreds of them. There was a big banking bust in Eastern Europe in the late 90s, big banking bust in Southeast Asia, Japanese banks went wallop. There have been occasional banking busts in parts of Europe. There have been regional banking busts regularly in the United States. The savings and loan bust, which was mostly in the south, but not exclusively in the south, was huge. There was a big regional banking bust in Texas in the early 1980s, and in the oil patch generally, and so on. So banking busts are common. They're not rare things that happen very infrequently. They happen very infrequently in this country, that's true. But they're common enough around the world. So Patrick, anyway, one of the things he said in this paper is that the assumption by government of open-ended guarantees in the middle of a currency or banking crisis is often done without sufficient consideration of the potential magnitudes involved and of the alternatives available. Now, it's a pity nobody in the Department of Finance read that prior to the guarantee, but they didn't. So I was very upset in October 2008 when the government guaranteed all the liabilities of the banking system, because it was afraid that it mightn't work out, and I said so at the time. Guaranteeing all of the liabilities of the banking system, and remind yourself what I said a minute ago now, if you're in the Eurozone, those liabilities are for all practical purposes in a foreign currency. These are liabilities in a currency that you can't issue. It's very different for, you know, if the government of, I don't know, Ruritania decides tomorrow to guarantee the liabilities of the Ruritanian banking system in Ruritanian washers or whatever they use for money, well, that's cool. They can print it off. But to guarantee the liabilities of the banking system in foreign currency is a different day's work. So one of the things I thought was interesting to do was to take, this is a little bit technical, but it's not very, to take the IMF database, which identifies 84 banking crises which resulted in budget costs to the government. Some banking crises don't. And have a look at the shape of that distribution. And sometimes a banking bust costs the government 2 or 3% of GDP, 4% of GDP. But sometimes it's 50%. And that is a distribution of the fiscal costs of banking crises. And what it shows is over to the left, the vertical axis is frequency, and across to the right, the horizontal axis is percent of GDP. So you can see that most of them are over towards the left bottom corner, which means they just cost a few percent of GDP. So the peak of the distribution is just there, and there means 4 or 5%. That's 20%, 40%. But look at the rest of the curve. That curve is what they call skewed to the right. And what it's saying to you is that there's a non-trivial risk that the cost will be huge. That's really what the curve says. The curve doesn't just zoom up here and then go straight back down again there. If it did, it would be telling you this is probably going to cost you 3 or 4% of GDP, but it won't cost you more than 8 or 10 or something. But it's so skewed to the right that there's a non-trivial risk that you could end up where we did. And that curve is fitted to a worldwide data set that's been available for many years. So, what do you conclude? It's dangerous for governments to guarantee all the liabilities of the banking system, even if the government is starting off from a good fiscal position. That's in a nutshell what happened to us. The other problem is that if you juniorize holders of sovereign debt, juniorize means you skip the queue. You decide to put somebody else ahead of the sovereign debt holders, like government writes a big check to the people who own bank bonds, for example. That weakens the creditor position of the sovereign bondholders, or you put official lenders ahead of them. That, in my opinion, makes sovereign debt uninvestable for traditional holders. And the Greek default cost private sovereign holders of Greek debt 100 billion, and of course cost the ECB nothing. I'm going to skip this little bit here. What do we need to do to sort out this out at European level? We need to have a monetary union instead of what we have. It's called economic and monetary union. It's not. A proper monetary union has centralized bank supervision, a centralized system for resolving banks that go bust, and a centralized system of deposit insurance. And the United States has had all of those since the 1930s. And if you don't have all of those, you don't really have a monetary union. To put it another way, there was a big bank bust in Texas in the early 1980s. And it was serious, and most of the banks in Texas went wallop. But the governor of Texas did not have to deal with it. It's federal. It's a monetary union. And similarly, when all the banks that went bust in America, Lehman's, but also Washington Mutual and a whole lot of other ones went bust. They're actually all registered in Delaware. Now, the feds didn't say it was nothing to do with us. These banks belong to Delaware. The governor of Delaware can sort it out. So the United States really is a monetary union of 50 states that share a common currency, but they also have federal, centralized arrangements for bank supervision, for bank resolution, and for deposit insurance. That's called a banking union. And to set up a currency union without a banking union was always very risky, and it was always dangerous to be a part of it. So they'll have to try and retrofit something like that. So I just want to wrap up, if I may. This crisis is not over. Over the last 6 weeks, since the beginning of May, there has been a bit of a blowout again in sovereign bond spreads in Europe, and the Greek bond yields have gone back into double digits. Last time I looked, Spanish 10-year bond yields were at 450. Bells start to ring at about 5 or 550. So at some stage, as central banks begin to pull liquidity back, I think you begin to see real pressure in those sovereign bond markets, and there will have to be some action at European level if the common currency is to survive. And the problem is that there are still zombie banks in Europe. There haven't been proper stress tests as there were in the United States, and there's still a lot of nervousness about continental European banks. The price-to-book ratios of some of the continental European banks are down at 50 and 60%, and some are even lower than that. And of course there are zombie treasuries, as we know, ours being one of them. Consequence is that sovereign debt is risky, and I really wouldn't be too happy about any portfolio that had particularly long-dated sovereign debt. I think interest rates are heading up anyway, and there are non-trivial default risks with some of the countries. We've seen that now in Greece. Arguably, there will be a sovereign default in due course in Cyprus, since the Cypriot bailout was botched. Bank deposits in Europe are not insured properly. People talk about this 100,000 guarantee on bank deposits. It's a guarantee, though. It's not a deposit insurance fund. There is no deposit insurance fund in most of the European. Some of them have, actually, but it's country by country. It's a guarantee rather than a deposit insurance fund. In the United States, if you have insured deposits in a bank, that bank pays the feds. The amounts vary, but they're like 0.1% per annum. Numbers like that, a little bit less. They vary bank by bank, a little bit less sometimes, a little bit more other times. And that is their payment for the insurance. Insurance is not free, but of course the feds have a big fund to pay out when a bank goes wallop, and the feds also have a credit line with the Federal Reserve Board. So the Americans have an actual, real deposit insurance fund, and of course you don't get bank runs then. But in Europe, what we have is a guarantee, which means a speech by a politician. That's what it means. What do I think is going to happen on? I'm often asked this by people. Is me few quid safe in the bank? Terrific state of affairs. But anyway, people do ask you. I think it would take some kind of Armageddon for a banking bust to emerge in Ireland that would see deposits under 100,000 getting hit. But we've seen deposits over that amount hit in Cyprus, and I have no doubt that if a sufficiently large bank bust happened anywhere else, that they would certainly look at that. So I think deposits over 100,000 are risky, and more generally, the Irish banks, their shares obviously are uninvestable. Royal Ascot was on today, and there was some good value on offer if you fancy that kind of thing. But more generally, they still have to clean up their balance sheets. There will be a big stress test on the Irish banks later on this year, early next year, and we'll see whether they're out of the woods or not. So I think sovereign debt is risky. Don't like the look of it. I think the interest rates are not going to go up much in a hurry, but they could increase quite quickly if the European economy begins to recover. Bernanke made a speech day before yesterday, which caused a bit of a sell-off. The United States economy is doing okay. The crisis in America has been managed much better than in Europe. If the US economy does begin to recover, the Fed will pull back from quantitative easing. Bernanke said that more clearly than ever this week. And I think you will begin to see interest rates in the United States move upwards. And, yields on Treasury bonds have already risen. In Europe, that will happen too, perhaps a little bit later. And when it happens, it'll happen in response to developments in Germany and in France, in particular. And if the German economy begins to recover quickly, they will push for interest rates to go up. And if that doesn't suit the peripheral European countries, well, interest rate policy in Europe never did. I don't think inflation is a short-term threat. People have been getting excited because there's been a lot of loose monetary policy, but the loose monetary policy is in the middle of a huge downturn, and I don't think that there's any imminent inflation threat. But the central banks have to unwind at some stage, and that means higher interest rates and lower bond prices. Long duration bonds, especially in countries with default risks, are most exposed. A final point, one of the things that happened during the big crisis of confidence in 2009, 10, 11 is that all asset prices got highly correlated. Everybody was dumping all kinds of assets. It was a risk-off world. And asset prices that normally wouldn't be highly correlated became highly correlated. That will unwind in due course. And liquidity concerns can't drive markets forever. I always try to avoid giving people advice that I wouldn't follow myself. Whatever few quid I have left after the depredations of the taxman at the moment is in cash and equities. Right? I don't have any long duration. When I say cash, I mean cash and short-term treasuries and stuff like that. Don't like to look at property, and I don't like to look at all of long-dated government bonds. Okay.